invest in and follow principles. That has proved to be pretty successful.
This landlord's going to make almost $2 million over the next 12 years for doing something one time. And that's like residual. This guy's got another 7 retail spaces and he's got 10 stories of apartments above it. And I'm like, man, I'm on the wrong side of the coin, right? I need to own real estate, not broker it.
You start doing deals that are absolutely life-changing, like that put you on the path for intergenerational wealth.
Welcome to the Real Estate HomeRuns podcast. I am your host, Louis Van der Horst. This is a podcast for busy professionals who want to learn about passive income producing strategies that have helped others crush it in the real estate world. Whether you are a new or seasoned real estate investor, this is the podcast for you. Welcome back to the Real Estate HomeRuns podcast, everyone. We have Mark Perlberg today. Mark, thank you for joining us.
Yeah, thanks for having me. Happy to be here.
So tell us a fun fact about yourself and something about your background.
Absolutely. So I'm a CPA specializing in tax strategies for real estate investors and business owners. A fun fact is last Saturday, I took my cat ATVing in the mountains of Guatemala.
Oh, nice. Did it come back speaking
That's
Spanish?
That's something you don't hear every day. Yeah.
Nice.
Absolutely.
Do you like to travel often, or this was like a once in a lifetime trip to Guatemala?
Yeah, no, I like to travel as much as I can. I'm virtual, so I can be anywhere I want. So especially during this time of year, even Atlanta, it gets a little dark and gray in January. And with busy season around the corner, it's just nice to catch some sun and enjoy some good weather while I'm here. So I'm actually living in Guatemala for the month of January before busy season and working out of Guatemala.
Nice. So you're in Guatemala right now?
Yeah, life is good. T-shirts and
Wow.
jeans. It's sunny. It's beautiful. Life is great.
That's awesome. I have been to San Lucas down there. Zacatepeques, I think it's like the province. Yeah, good people.
Nice.
The food is really good. I feel like we ate a lot of beans while I was down there, but it was on a missions trip and it was good.
Yeah, I'm in the mountains right now in Antigua, Guatemala. Wonderful place.
Awesome. And before the podcast interview recording started, you said that you have been in business for 3 years as a CPA. Is that how you started right after college, or this was something that you always knew you wanted to be involved with as a CPA with finances, things like that?
Yeah, absolutely. So, and I'm going to close the window as we talk, but
No problem.
my journey to doing what I do is I'd always been an enthusiast in the world of real estate and real estate investing. I used to be a real estate agent, and I realized the money was in owning, and so I started hanging around. Eventually, in my past life, I was a teacher in New York City, and I was a real estate agent to help fund my education to get my certification. And I wasn't too crazy about the limiting opportunities of being a teacher, and I was selling real estate during the worst time in history to do it, around 2009, 2008. So I moved down to Southeast and changed my career to study accounting with the idea of investing in real estate and doing accounting and hanging out with other investors. Naturally, everybody started asking me how I could reduce my taxes. And I didn't know the answer. I was almost embarrassed. I'm like, how am I a CPA and I can't answer these questions? Am I going to hire another CPA after all the work I did to do my taxes? No way. And so I started figuring it out and taking on a handful of clients. And before I knew it, it became a full-time practice.
Okay. And what did you teach when you were a teacher?
Teaching social studies.
No way. That's my subject.
Yeah.
I'm a social studies teacher, teaching middle school and been doing real estate. The goal is to eventually take on real estate full time as an investor.
Yeah, I was doing it in New York City during a hiring freeze. So we were forced to do substitute teaching because we weren't allowed to work during the Great Recession. The labor unions said that we absolutely were not allowed to work. And this was before the Affordable Care Act. So we weren't allowed to have full-time jobs with any benefits. We didn't qualify for health insurance. And at this time, health insurance, you didn't have the health care marketplace. So, we were uninsured. And it was a really rough time for teachers during that time. But I bet nowadays, especially being the flexibility and the freedom you have to be off on summers, you could probably do some really powerful stuff as a teacher.
Yeah. And something that attracted me about real estate is seeing how I could really work my tail off to get a deal to the closing table and be able to make a nice, decent chunk of money.
Yeah.
And that's how I got started with real estate and learn about even Rich Dad, Poor Dad. And I'm now teaching that to my students, encouraging some of them to read some extra copies that I have in my room, because once I was able to understand that, it completely changed the ball game for me.
They're requiring financial education in North Carolina. I think it's a wonderful idea, and they didn't do it when I was a teacher. It's wonderful that students should be thinking about these matters at a young age is so important for their development. And also as a teacher, I mean, if you have your summers off and man, that's the rush season for selling real estate. As long as it's not the worst, drop in real estate in history. I mean, it would be an awesome idea to get a real estate license and hustle some properties on the summertime.
Yeah, I started off buying my first rental from an investor and then started wholesaling. But just seeing where things are going, I've been considering my license for that reason too. Yeah.
Very cool.
So what are some things that you're seeing that some investors perhaps neglect or overlook when it comes to their finances and reducing their taxes?
So when it comes to reducing their taxes, I think that a lot of investors, the challenge with a lot of investors is with their mindset. And as a real estate investor, especially starting off where you're so dependent on having capital and investing in putting all your money into these properties, you kind of develop a very frugal mindset. And sometimes investors are looking to cut costs in the wrong places. And so they'll try to self-prepare their returns and not realize that they're leaving a lot of opportunities on the table. So I just looked at a return today, and I think the client probably overpaid in taxes by maybe $45,000 because they were self-preparing and they were misclassifying some of their income. And then when we think about the errors on self-prepared returns, one of the greatest missed opportunities is with cost segregation. If it's possible that you can save money with a cost segregation study, which is when you front load your depreciation, these are instances where a client may be missing out on maybe tens of thousands of dollars typically in savings that we can create with those cost segregation studies. But when you're in this DIY mindset and you're looking to cut costs and not hire an accountant, you're not going to be able to recognize the opportunities to do such things.
And for those listeners that are listening for the first time perhaps and are hearing cost segregation, would you mind giving us like a basic understanding of it?
Absolutely. So what we do with cost segregation is we look at a property and we realize that not all this property is really real estate. Here's the thing is that real estate typically will depreciate over 27.5 years if it's residential, and if it's non-residential, 39 years. That's a long time to write off the purchase price of this property. I mean, you're putting 20% down on this property to buy it. And some of its lands, which won't depreciate ever, you will get no write-off. And then the amount that's building, you'll be able to depreciate around maybe 3.6% per year. So in order to get more of this depreciation up front, we evaluate these properties and we find that some of these properties are actually not real estate. For instance, the cabinetry, the driveway, ceiling fans, and the curtains, these are all non-real estate items. And we assign a fair market value to all these items. And what we can do is we now have shorter depreciable lives for these items. They will not depreciate over 27 or 39 years. The ceiling fan and the cabinetry will depreciate far much faster. And what we can do is we're front loading the depreciation and we're getting more of that write-off up front. And anything that depreciates in 20 years or less qualifies for bonus depreciation, so we can write off 100% of those items in year one. So we've had instances where we may even wind up writing off up to 50% of the purchase price in year one for certain assets. My rule of thumb is typically we can write off around 25 to 30% for your average real estate asset with a cost segregation study.
And this can be applied to single family and a commercial multifamily as well?
Absolutely.
Okay. Is there like a certain type of certification that someone needs to be able to do a cost segregation study, or what would that look like? And when it comes to vetting CPAs that are qualified?
So I've heard of a few CPAs doing their own cost segregation studies, but I never actually do the cost segregation studies. We evaluate the opportunities for the cost segregation studies, and we work with the cost segregation engineers to conduct the studies, or we may run algorithms with a third-party provider. But when we're thinking about who's going to conduct them, we work alongside them to make sure they're getting the right numbers and basis of the property. And then there are certifications, but we're not so much concerned. I mean, the IRS has their own auditing techniques for evaluating these items, and most of our resources have a vast experience in performing these items and will provide audit support.
That's good to know, because I hear the term mentioned a lot. I have a general idea about it, but didn't know what it looked like behind the scenes for it. But it sounds like a great benefit to investors.
Yeah, to me, right now in our current tax environment, cost segregation is probably the most impactful tax strategy there is for real estate investors. And I have a client right now who will reduce her taxable income by as much as $500,000 in 2021 with cost segregation studies. So, I mean, it's just in our current tax environment where we have 100% bonus depreciation, and whether you like him or hate him, you can thank our prior president, and based on his occupation, which may have impacted the tax code, but that bonus depreciation is going to phase down in the future. But right now, that's just, you have to consider it, if at all possible, you can do some really powerful stuff.
Good. Are there any changes that perhaps could impact real estate professionals and investors as far as
absolutely.
like tax laws?
So we already, and regardless of who, this is not impacted by Joe Biden, but with the Tax Cut and Jobs Act, which created this 100% bonus depreciation, that amount of bonus depreciation is going to phase down over the next couple of years. So right now it's really good, and it has been really good, where any item where we talked about earlier with the cost segregation study, any of those items that depreciate, that's non-real estate, we can depreciate 100% in year one and get all the tax benefits of that write-off. Also with our vehicles over 6,000 pounds and all these other items. Now, what we're going to see is in 2023, we're only going to be able to fully depreciate 80% in year one, and then the remainder amount over the life of the asset. And then in 2024, it's going to be 60, and then 40, and then 20, and then pretty soon we're going to have no bonus depreciation. So really right now is a golden era of tax savings available for real estate investors. There's going to be many opportunities down the road, but right now I can't imagine it getting any better. You're going to need to be more and more resourceful in the future. There are some proposed changes in the treatment of S-Corp income. If we want to talk about active income, so if you're flipping or wholesaling or a real estate agent, there's some potential challenges that we may see in the treatment of S-Corps, but I don't want to go down too many rabbit holes and make too many assumptions about that right now. So the big thing is just the phasing out and down of bonus depreciation. Another thing is if our rental income results in positive taxable income, if our revenues exceed our expenses, we right now, real estate rental income qualifies for qualified business income deduction, or QBI. And that basically means that 20% of that income is deductible because you're a business owner, and the IRS says, well, we're only going to tax you on 80% of it, with some other exceptions. We don't have enough time to go through all of them, but we're expected to lose our QBI deduction on any taxable real estate rental income as the Tax Cut and Jobs Act phases out as well.
Okay.
And that'll be in 2027.
Got it. I guess it would take for investors to connect with the right people to figure out how to maximize on tax benefits and write-offs. Because if there are more restrictions coming up, you will want to be ahead of the curve.
Yeah, I would say that now a lot of our tax strategies are relative. They can be somewhat simple, and we have a lot of strategies where we can quickly create hundreds of thousands of savings. It does take some analysis and procedures, but what I would say that in the future, we're going to need to become more resourceful, and there are going to be more complex strategies to maximize the tax savings for our clients.
Let's maybe take a different take on things and share with us what are some things that people should be looking for when they're trying to identify a good CPA.
I think one of the easiest ways to identify a good CPA is ask for a referral in someone who already knows, someone who's already has a proven success, proven track record. The CPA, some CPAs have testimonials, which are great. If you know someone who is doing something similar to you and can testify to their results, that's fantastic. You may also want to consider that you make sure this CPA is at least knowledgeable in the type of real estate investing that you are doing. And I was going to say something else. I think that also consider the fact that, especially in this environment, you don't have to go to a local CPA. I serve clients across the country. I have clients in North Carolina, New York, Texas, Tennessee, all over. So don't limit yourself to your neighborhood CPA. Find the best one you can find in the country who works for you.
Yeah. Just like what we're doing right now, could be they could have a Zoom meeting and be able to
absolutely
interact like that. That's good. Yeah. Are there any, maybe book recommendations that you have or resources that are available to the public or whoever is out there and it's like, oh, I just want a general idea to better understand it on their own?
Okay, so there's a few of them for general tax strategies and tax concepts. I think the book by Tom Wheelwright, Tax-Free Wealth, is really good. There's another, Amanda Hahn, she's a CPA, and she wrote a book. She wrote 2 books, the Bigger Pockets series, called The Tax Savvy Real Estate Investor and like the Advanced whatever. But both of those books are really good as well. And I think that there are some decent books in the Rich Dad Poor Dad series that talk about taxes and tax loopholes and stuff for real estate investors.
Good. I read Tax-Free Wealth by Tom Wheelwright, and that's, man, powerful book. And even the little things that he mentioned that can have a huge impact, like having your kids be part of the company and you pay them, and that's keeping the funds in the family. Yeah,
I mean, I love that book as well. And, you know, we love using that strategy of hiring the children. So one of the things we recommend is if your children is maybe a teenager, you get them to manage your social media accounts, and you can pay them the fair market value of social media consulting, which can be pretty significant. I mean, pretty soon you can get to that standard deduction where the kid pays no taxes and you write off all your taxes. I hired someone who, as a 1099, to do some tax work for me, and we're also hiring her kids to do some admin work. And so she gets the money, she pays her kids, and she pays no taxes on it.
Wow. So win-win-win.
All around. Yeah, absolutely.
So what are 3 things that have helped you hit real estate home runs, singles, doubles? That's a question that I like to ask every guest.
I think the first one, and this is a small one for beginning investors, my very first purchase was just an owner-occupied loan, and I was broke by the time I got it. When I was a W-2 employee, and I bought an owner-occupied loan for a property, and eventually sold it a couple of years later for $50,000 profit, and I also house hacked and lived for free. And I guess if you were to assign a label to that thing, is taking advantage of owner-occupied loans and house hacking just to get started. And also, again, not overthinking it and just closing to a deal. Evaluate the worst case scenario. Society will not shun you if you don't do the perfect deal. If you lose a little bit, even if things don't go out perfectly, someone is eventually going to rent out the place, right? I have one colleague, one friend, who's been reading books and backing out of deals for the past 2.5 years. The most important thing is you just get started, right? So that's the one thing. Just get started, and if you don't know what to do, just buy real estate and turn it into a rental of some sort. I eventually moved out of that place and turned it into a rental, cash flowed about $800 a month. Another thing I would say for real estate home runs that I've had is, this is an obvious one. I guess I'm going to take a perspective of a CPA on this one. Is let's say short-term rental investing. So right now in our current tax environment, I would say that short-term rental investing is the easiest way to reduce your taxes and get rich. I started, there's a major loophole in real estate rentals, which says that if the average length of stay is 7 days or less, that this property is actually not actually rental activity. So when we evaluate the treatment of activity, if it's not rental activity, it's not passive. So we evaluate it as though it's a business under certain circumstances. So basically, before that, all our losses and write-offs are kind of limited and stuck in this passive income bucket and can't offset your W-2 income. But if we have short-term rentals where the average length of stay is 7 days or less, and we self-manage and materially participate, we can shift those losses from the passive bucket into the active bucket where our W-2 income is. And now we have the opportunity to create massive losses with cost segregation with our short-term rentals to offset the taxability of our W-2 incomes of us and our spouses. And we utilize this strategy, as I was talking earlier, where we've created hundreds of thousands of dollars of savings for people such as physicians and attorneys and bankers. They don't need the real estate professional tax status, massive savings. So the short-term rental tax strategy is another major home run available for almost anyone listening to this podcast. And then I would say third real estate home run that I would think of is, let's go back to, if we want to talk about real estate strategies here, I think another home run that I've had with our clients is with recognizing and being proactive in understanding the category of income that we are receiving. So I think that if we can be, we hired a client who had a passive shares of a business. He was a passive investor, and he also invested in long-term rentals. The prior accountant misclassified the income as being passive, as being active, but we actually realized he had passive shares of business. And anyways, we were able to net the losses from his real estate against his passive business shares in a startup that he started, a tech startup. And we anticipate we'll reduce his taxable income by about $500,000 next year. And I'm going to add another one because I probably should have said this instead. If you're doing flips or wholesaling or you're a real estate agent, is recognizing the opportunity to create an S-Corp to reduce your self-employment tax.
Wow. It seems like with those nuggets that you gave there at the end, those could be like whole episodes on their own. They were so good.
Oh, absolutely. Yeah. So much more to the story on those topics.
Yes. And the one about the short-term rental, I did not know that, but it seems like that's the buzzword now, short-term rentals. And you're also not tied into a tenant-landlord situation long-term.
Yeah, you don't have to worry as much about it. You don't have to deal as much. I mean, it's more work typically than long-term rentals, but your margins are higher, and you typically don't have to deal with evicting tenants, which is nice.
Yes. So how can people stay in contact with you, Mark, and learn what you're up to?
So for anyone who wants to be a prospective client, you email info@markperlbergcpa.com. If you're interested in learning more about real estate, tax strategies, and anything else that we are doing, I recommend you follow our YouTube channel. We do live webinars every month. So if you message us, we'll put you on our mailing list and invite you to our free live webinars. Our webinars not only go on YouTube, but they are also recorded and put on podcast format now. So you can follow us, our podcast, on any player. Those are the greatest ways to just stay on top of what we're doing and maybe consider us as potentially one of your advisors.
And what's the name of that YouTube channel?
All right. So you can just YouTube Mark Perlberg CPA, and the podcast is the Mark Perlberg CPA podcast.
Hey, thank you so much for joining us. I really enjoyed it, and I got a ton of value out of this.
Absolutely. Thanks a lot for hosting me. I'm happy to be on this anytime to talk to investors and share some good information.
We hope you enjoyed this interview and got some value out of it to help you in your real estate investing journey. If you can take just a minute, please do us a favor and leave a review. Hit the like button on iTunes or whatever platform you listen to our podcast on, and subscribe so you can hear future episodes. Also, don't forget to check out our Real Estate Home Runs Podcast Community Facebook group, where you are able to connect with some great listeners. If you're an investor who is crushing it and want to share some information centered around passive income in real estate, please contact us. Hit those home runs, and we will see you next time.